Well, with an introduction like that, if I were a rational man, I would smile, thank you all, and sit down. I don't think I can improve on those fine remarks that he had to say about me, so we know which direction it's likely to go from here. I'm deeply honored to have been invited to speak at this consequential event. I believe it's the 18th. There are not many that are going on into their second decade. As my topic, I promise not to be too analytical. I know you've been quantitative, I should say. You've been at it all day. And I'd like to talk, of course, about the role of finance science in practice, but focused on observations from the current crisis. And let me say at the outset, there have been huge mistakes made. There are both bad and incompetent people in the private sector and government overseers of the financial industry that have disgraced it. Fools or knaves, it doesn't much matter when you have the outcome. However, my focus this evening is on the structural reasons that we have contributed to what has happened. Reasons that are driven even in an environment in which the participants are ethical and the participants are well informed, but that these are structural. If these are not recognized in the ensuing attempts to improve the system, we will not make much progress. My remarks are divided into 4 parts. The first, I'll talk about the structure of credit risk propagation, since credit risk and guarantees have been at the center of the financial part of the crisis. And I'll talk about questions that have been raised, such as how can large macro risks build up without recognition and then appear to explode? Why do banks continue to report larger losses even after booking no new risks, leaving static portfolios? And then, throughout this talk, the issue of, do we need a new finance paradigm? My second point will be around the issue of financial innovation. As you're all quite aware, there's been much said about the role of financial innovation in creating crisis, and so I want to say some words about the relation that exists between financial innovation and crisis. There is fact, but as I will also suggest, there's fantasy. Third, we've heard much about models, the failings of models, the contributions or dependence on models to this event. And what I want to tell you about is that the inevitable incompleteness of all models, whether they're mathematical, whether they're accounting, regulatory, or just simply in our heads. And then my last points will deal with the issue of government policy on the financial crisis. How far I'll get into that, I've been told to be careful, so I have my watch here so that we can get on with the rest of the events. But I do need to address that because it is timely, it is going on, and I think finance science and experience has much to contribute to it. I will talk about, if I get through all of it, the unanticipated consequences of social actions. I will talk about guarantees, the issue of whether you should inject capital and take over an institution or let it go bankrupt. What are some of the big issues? And then regulatory reforms. If time permits, I will even offer some of my own recommendations for reform. And from this, I will conclude that we are observing in a crisis, a very bad crisis, but not one in which we're going to find many new particles, and not one in which the existing finance paradigm needs to be largely replaced. The existing tools will work. Now let me turn to the first topic. I'm going to take advantage that this is a finance group, so I'm going to make some assumptions of knowledge. In fact, much of what I'll say in this section, oops, I need this for a pointer. I say in this section, I know many of you know. But I know also many of you are teachers and advisors. And it is essential in this crisis that you take and use your knowledge to help others to really understand what's going on. So if you'll forgive me if some of this seems elementary to you, I'm really going through it with the purpose in mind of showing how you can use the modern tools that we know, tools that we have are market proven that we've used for years, to help others to see structurally some of the things that are going on and take away some of the mystery, if not provide outright solutions. So I want to start with the description of, we're talking about credit risk, and am I echoing? Is this echoing? Can we just lower it a little bit? Is that better? All right. Well, anyway, if we come to here, let's start out and talk about, just very quickly, what does it mean? What are you doing when you lend money? When you're either an investor or a creditor who lends money. Here's a piece of risky debt. It could be a bank loan, it could be a bond, it could be a mortgage. And for the purpose of risk here, I'm going to be focused on default, credit default. In other words, the issuer of this may not pay. Now imagine I have another piece of paper that I'm given, which is a full faith and credit guarantee of the government of these payments, and I staple them together. Well, as long as you have faith that the government is good for it, and of course that's been in debate too, but we won't go there. What do we have functionally once we put the two together? Basically, we have nothing more than risk-free lending, which we all understand, time value of money. You lend money now, you get interest payment back later. Okay? So then functionally, what is this piece of paper by itself? If the two together is risk-free lending, then if you take this away, what's left is risk-free lending minus this. Well, what do you mean minus? Well, instead of having a guarantee, you're writing a guarantee. So the first thing I want you to establish here, that whenever you lend, you're always performing two functions. Time value of money, risk-free lending, and, let's see if this helps. I pushed the wrong number. Oh, I guess is this a laser? Oh, yes, okay. Thank you. I'm revealing my technological prowess here, all right, so you have risky debt is nothing other than risk-free lending, writing a guarantee. Okay? So you're doing two things. You're lending money through time, and you're writing a guarantee. What is guarantee? Guarantee is insurance. So you're in two businesses. You're lending money, and you're writing insurance. Now, writing insurance is an old and very honorable profession. However, it's very important that if you write insurance, you know you're doing it. You need to know you're in that business, and this is always true. Now, let's see if we can make some progress from there and explain what it is. So now we would figure out a guarantee. So let's take a corporation here. It has assets, it has debt, it has common stock. If you prefer the mortgage market, then make that a household. That's the house is the asset, the debt is a mortgage. Okay? So you choose whichever you prefer. I'll use corporate. All right? Now, we know as the identity that assets always equal the debt, the left side always equals the right side, both in value and risk. Now, let's consider the day of destiny when the debt's to be paid. And if the promise payment on the debt is B, the face value, called 1,000 euros, then either one of two things happen. You get paid what you promised or you don't. Now, if you get paid what you promised, end of story. And having a guarantee on that turns out to be worthless. The insurance wasn't needed. Just like with your car. You insure your car for a year. Thank goodness, no accident. You bought the insurance, but you didn't need it. So the insurance is worthless at that point. But what happens if you're not paid, if the corporation doesn't pay? Then what happens is having that guarantee is equal in value to the promised payment that you will receive from the guarantor, because that's the guarantee, minus what you would have collected by taking over the assets as a result of the bankruptcy. So it's B minus the value of the assets A. So I can write this, that the payoff to the guarantee can be written as the maximum of either zero when you don't need it, or the difference between the promised amount and what you can liquidate the assets for, B minus A. Well, looking at that, what is that structure of a payoff? That's a put option. It's a put option where the strike price is the face value of the debt and the asset is the underlying assets of the lender. This is we know these options very well. We've been trading them for 35 years on listed exchanges and all the rest. So we say, well, all right, what are you telling me? We know all of this. I said, well, now we see that the value of a guarantee is just a value of put option. Now what leverage have we gotten? Well, because we know so much about put options, not just in academia, but in practice and experience, the learning curve, by recognizing that correspondence, we can bring all the technology and science that we've experienced in that field to understand the valuation of guarantees. And that's the payoff from that, recognizing that correspondence. By the way, the alphabet soup we've been seeing here, CDOs, CDSs, and all these things, credit default swaps, which have been at the center of much of the fury, are nothing more than guarantees of credit. So essentially, CDS functionally are equivalent to put options on the underlying assets. Okay, so that's the message of this slide. So we've gone from not knowing anything to being able to see we know a lot about the structure of guarantees. We saw that debt lending is riskless lending, which we understand, plus writing guarantees. So now we know that. Let's move on. What do I want to get to? Well, I know this group. If we plot the value of a guarantee versus the underlying assets, since it's a put option, we know that it's going to have a shape like this. Okay? The value of the insurance goes down as the asset goes up. The value of the insurance goes up as the asset goes down. It's curved and it has that shape. I take that everybody is quite aware of. Okay? Now, when we start here, at the time, let's say the loan is done, the assets have a certain value and the guarantee has a certain value. What happens if there's a shock or a cumulative loss where the assets fall to here? Well, of course, the guarantee goes up. That means the insurance value goes up, which means what? The loan is worth less. We can figure that out, right? Because it's minus. You've written the loan, the guarantee. But the main thing I want to point out here is this slope and the shape of the curve. When you're here, if someone asks you, what is my exposure to the underlying assets of the lender? For a little movement, it's going to be roughly the slope of that line. So if the slope was 0.3, it says for every dollar or euro move, you get about a 30-cent change in the value of the guarantee, which means a 30-cent change in the value of your debt. Okay? And that gives you an order of magnitude of how risky it is. Well, when you get to here, everyone's going to recognize, or not everyone actually, but most people should recognize that the guarantee is going up, so that's not good if you're the writer. But what they don't often understand is something else has changed, the risk. Because now if you ask the question, what is the exposure to a small move from the underlying assets? It's not 0.3, but maybe it's 0.4. It's gone up. You see the slope's getting steeper, and it will keep getting steeper. Now, anyone who's done derivatives knows this is derivative 001. But I assure you that in the operating world, mainline credit, and in macro financial analysis, this isn't well known. It's not the way to think about it. As a consequence, the risk is that you can have, or the worry is that you can have big risks occurring when assets fall, even though nothing has been done about the loan. So you have a book of loans, you do nothing with it, you haven't changed it, but by the assets going down, not only is the value of the loans gone down, but their risk keeps going up. So if you have multiple shocks, if you think of this as the first shock, yeah, okay, we predicted that. But the second shock, the impact of that is much steeper, and that is usually not predicted. And if you have a third one, it's still steeper. So we already, from this simple structural model, we can answer questions like, how could it be that banks, if they're behaving themselves, we're not talking about the banks cooking the books or trying not to show it. I'm not saying that doesn't happen. I'm saying you don't need it. If the banks have stood still and just hold the same portfolio as they've been doing, they certainly haven't been consciously adding to risk. If you have a shock, it goes down, they're going to lose money. If you have another shock, not only are they going to lose more money, but they're going to lose it at a greater rate. And it seems very, very odd when looked at from the perspective. People say, how could they keep losing it? Where is it coming from? Well, you're seeing it here. Well, let me just extend that same thought one more step. Who else is engaged in this? The government. What does the governments do? Either explicitly or implicitly, they guarantee bank assets, deposits. Well, a bank deposit is nothing more than a loan, so they're guaranteeing it. So what are they doing? They're writing a put option on the assets. If they're writing a put option on the assets of the bank, they're really writing a put option on a put option that's been written. So they're writing a put on a put. Well, the reason, oh, you can see my competence here. Let's see. The reason that I put this up here, as you see, and this is the same for the banks, is that now, when you write a put on a put, you see you have this convex shape, this curve that gets steeper when things get worse. What do you think happens mathematically, or if you have a put on a put? You have something's convex on something's convex. If I were to plot this not against the assets of the bank, but the assets of the underlying corporation, it would be very steep. So it would be very flat, and then it would come up very much more rapidly. That's how you can get really insidious problems, and indeed that may give some insights into things of a different crisis, the 1997 Asian crisis, where Thailand went from nothing, nice, smooth, and suddenly it seemed overnight it got into a lot of trouble. Well, there are lots of reasons that could happen, but it doesn't have to be the arrival of a black or green or any other color swan that we never thought about. What it can come from is the recognition that if you don't measure it, you can be in very, very safe, low-risk territory as a government, but as assets fall, your risk can go up and up and up, and if you're not taking account of it, suddenly it hits you when the truth comes in, and it appears to be some kind of an event. And that's the message I wanted to give you from this. I know it's elementary, but it's at the core of understanding a lot of what we've seen from things that we know from first principles for years. You don't have to go out and invent some new complex modeling to do it. Does this explain everything? Of course not. But I wanted to point it out. Now I better move on. By the way, in the real world, it gets worse than this picture. Why? Because that picture was what happens when value goes down and everything else stays the same. But in the real world, everything else doesn't stay the same. What happens when assets go down, like the stock market? Well, as an empirical and a theoretical matter, volatility goes up. So what is the value? If volatility goes up, what does that do to the value of a put option? Goes up. What does that mean to the value of the guarantee? Goes up. So you're getting two effects hitting it. The assets are going down and the volatility is going up. So in reality, the price in the guarantee is much, much more than from this simple thing. Now, I've just put up an example here. This means this shows two shocks. But the cumulative story is you can have assets go down by 40%. You can have the guarantee go up by 300. Now, if you take a leveraged bank and you have that kind of implicit leverage, it's not hard to show that you can get astronomical impacts when you get very big shocks of these orders over time without doing it. So the message from this is that value and risk of guarantees are large and rapidly changing. Second, that the losses can continue and get larger even in a static portfolio. And third, I just point out, how many people, you know, this used to be a thing, I was going to say Goldman Sachs, but I guess I could still say Goldman Sachs since it's everywhere. A typical thing is that a reporter will call up someone at Goldman Sachs and say, hello, do you know what a normal distribution is? Yes. What's the likelihood of a 10 standard deviation event? And dutifully the person says, well, you know, once every billion years or something like that. Thank you. Then he writes a story with a picture of someone from Goldman Sachs. Says, we called up Goldman Sachs and we asked them, what's the likelihood of a 10 sigma event? And the answer was once every billion years. And then the follow-up to this in the story is, well, this event has happened 4 times in the last 6 months. And, you know, it's made to seem like everybody is out to lunch. Okay? Now, there are many things, including distributions. I'm not wed to the normal distribution or any other thing. What I'm saying, there are many things that cause this, but one of the things that we've just done will help you to see it. What causes the movement in the bond or the guarantee? It's a mixture of the movement in the underlying, the asset, compounded by the slope, right? Because the guarantee we saw, remember in the previous slide? You see, the effect on the guarantee is a movement in this, but then how big a slope it is. If you have a very low slope to begin with, then a sort of 2 sigma move, 2 standard deviation move in the asset, even if it were normal, will produce a much bigger impact on the guarantee than you would think, therefore a much bigger impact on the debt than you would think, because you've underestimated the degree of sensitivity or slope. So, in fact, you can show in these models that with the kinds of moves we've had in asset markets and residential real estate, that in fact the slopes could be 4 or 5 times easily, 4 or 5 times larger than they were originally. So if someone is just fitting a statistical model, which most macro finance models are doing, or log linear, I don't particularly care, okay, you're going to end up underestimating the slope. Therefore, what's a 2 sigma event is perceived as a 10 sigma event because you've underestimated. Okay, end of that. Oh, I should give credit. Dale Gray and has brought this technology into understanding just the flow of macro risk throughout economies. He's done an enormous amount of both empirical and theoretical work, and it's taking hold. And I recommend to you not that you buy the book, even though I wrote a foreword to it. I have no economic interest in it, but I do recommend you become aware of this. This is a very important area going forward where we can help. Okay, second topic. Time check. All right. Second topic, we talk about financial innovation in crisis. I think you would all agree that that's been a topic. All right? All this financial innovation in crisis. Now let me talk about a true structural relation that's going to exist between innovation and crisis. And that is successful innovations will always be running ahead of the necessary infrastructure to support it. Why is that? Why can I say that? Well, think of innovation. Suppose you have 100 ideas, 100 financial innovations, and you introduce them. What fraction will actually succeed? Very small. It's not true that most innovations even get done, and when they do get done, most of them a flop. So let's just make up a number. Let's say 98 out of 100 fail. It is not practical to work out and build an infrastructure to support all 100 innovations before you know whether they're successful. Therefore, for successful ones, structurally, you would forecast that they're going to have an incomplete infrastructure to support them. Well, what do we do about that? Well, we better take account of that. It'd be a little bit like analogous if a high-speed train. You build a train that can go 300 kilometers an hour, but you have track, as I have in my hometown of Boston, going to New York, which would never support 300 kilometers an hour. You better not run the train at 300 kilometers an hour. You better take account of that. At the same time, if you impose a speed limit on the train that is the same speed that the trains have been running on now, you won't have any problems, you won't have any innovation. So it's always a trade-off, and we need to recognize that. And that's all I really wanted to say. One, that is a structural thing. We need to be aware of it, and it isn't going away. It isn't a matter of bad policy. It isn't a matter of bad people. It's a structural problem, and we need to address it as such. Now let me go to the part which is fantasy. And it's based on some behavioral finance that we've had documented, which is the idea that we perceive that which is new to us as being more risky than something that we're familiar with, even though they have identical risks. And that's pretty common. And I don't say it's a bad thing, it's just, but whether it is or not, it's common. So how does that relate to innovation? Well, I'll tell you a little story about something else, but it's about finance, to illustrate this. At the time of Enron and WorldCom and all these, a number of boards got in touch with people, so some of you, I had, saying, can you come in and look at our company and tell us whether we've been Enronized? Do we have these SIV, special SPVs and derivatives all over the place and all this kind of stuff? You know, are we, been invaded? So you come in and you come back to the board and you say, I have good news and I have not such good news. What's the good news? You have no SPVs. You have no derivatives. Now, that's a little bit fuzzy, but let's say this firm has no derivatives. That's the good news. What's the bad news? You have a standard in the United States called the ERISA Defined Benefit Final Pay Pension Plan. Wow. Doesn't every big company? That's pretty familiar. It's a pension plan. Okay, so let's do a little analysis. All right? So let's go up here. We have a corporation, and on its balance sheet it has pension assets, which are to support the pension benefits. I know in Europe you have sometimes indexed. It doesn't matter what it's indexed. In the U.S. they're typically nominal. So the liabilities are essentially money-fixed, long-dated liabilities, like bonds. That's the final pay liabilities that have accrued. The assets can be whatever you put in. The purpose of the assets, however, it's clear, is that they are collateral for the promise. Those assets actually don't belong to the retirees. They belong to the corporation. But they're encumbered assets. They're there to ensure or to support the retirees. That's important to remember. So the incremental gains and benefits, at least unless the company goes bankrupt, will accrue to the shareholders. The pensioners don't get bigger benefits in these plans if the pension assets go up, and they don't get smaller benefits if they go down. They basically are fixed. So think of it that way. Now, what would be, and I'm not recommending this, this is not a policy statement for anyone here who's looking for advice on how to manage pension funds. What I'm about to say is not a policy suggestion, but imagine that we put the pension assets, it was a fully funded plan, we put the pension assets in exactly the same fixed income instruments, high quality, matched maturity to the liabilities, essentially immunize them, so that the two exactly cancel, they'll move together. I picked that case not because I'm recommending it, I pick it as a zero risk case. Do you see that the two will exactly, so that's a zero risk base. So the question is, how much incremental risk do you take by moving from doing that as a policy, okay, oops, I don't know if it's working. Anyway, you can see the upper one, to a different policy, which was at least prior to this crisis very common, and is still common even if it's not at the same levels. Namely, somewhere between 60 and 75% of the assets are put in risky assets, stocks, real estate, etc. Okay? That's normal. You go to the United States, everybody does that, so it could be more normal behavior. Okay? So now we ask the question, what was the incremental risk that we created? From moving from this base case of no risk to what everybody does. Just the increment risk. Well, you can see, if we had 100 in the plan, 75% goes into risky assets. From the base case, what we've done is substitute 75 risky assets for 75 sure assets or long-dated bonds. So the effect of that is to give up the return on the bonds on 75 and receive the total return on stocks at 75. Now, I assume everybody here, I shouldn't put it that way, that's a terrible one. Total return swap, that's a derivative. You do a total return swap, as the name says, you just swap in one set of returns for another, and the price is zero to do it because it's on the same amount. So if you entered into a total return swap where you receive the total return on the stock market and pay the total return on, let's say, 30-year bonds or 25-year bonds, okay, that would be an example of a total return swap. Do you see, and what would be the payoff to that swap? You'd receive the total return on 75. If it was done on 75, you'd pay the total return on bonds. Compare the two. Do you see that they're not approximately the same? They're not analogous. They're identical. The incremental risk from moving a pension plan from 100% in bonds, which I'm not recommending, to the normal asset mix is equivalent to entering into a total return swap for the amount that you've moved. It's exactly equivalent. They have exactly the same risk. Now, to scale this for you, unfortunately for everyone, for a lot more important reasons, General Motors, as you know, has gone bankrupt. General Motors had, in fact still does, I believe, has the largest corporate pension plan in the United States. Okay? And roughly it's called $100 billion. If they were following that policy, which they used to, they would have $75 billion in equities. So, the incremental risk for General Motors to have done that, which is standard policy, would be the equivalent of entering into a $75 billion total return swap where you're making two bets. You're betting on the stock market and you're betting on interest rates because you're paying fixed. You're paying the total return on a long bond. So you're betting on interest rate direction and you're betting on that. Now, to scale that for you, a 1 standard deviation move in that combination in normal times, not normal distribution, normal times, not during this crisis. You can get numbers that make you, but normal time. On 75 billion, it'd be about $15 billion. So 1 sigma, 1 standard deviation on that, $15 billion. For many years, the entire market capitalization of General Motors, not book, was less than $15 billion. In fact, a lot less than $15 billion. Now, could you imagine if I had gotten up, you now are changing roles, you're all now the stakeholders of General Motors, the unions, the employees, the stockholders, the creditors, okay? And I was the CEO, and I got up to you at the annual meeting and said, ladies and gentlemen, I had made the decision to enter into a $75 billion total return swap where we're going to pay fixed on the returns on 20 or 30-year bonds, and we're going to receive the stock market. I suspect that the lead director would get up and go to the podium and say, ladies and gentlemen, we're going to take a 10-minute break. And when you came back, I wouldn't be here. They would have sent me out for rest and observation. I go through all of this, not to entertain you, but to point out to you that the framing, that familiarity you have exactly the same risk. These are huge, huge risks, and nobody worries about them. But mention it in another context, like a derivative, and people go, they would literally fire you. We need to understand this. We are professionals. We need to convey this. We have to say risk is risk no matter how you frame it, no matter how you say it. Many of the problems we've gotten into has been all about framing things. Who regulates what is it structured, what is it called? That has to end, and there's no need for us to continue. So that's the fantasy, because innovations are always new, so the bias is going to be that they're more risky, whether they are or not. Now, I'm getting close, I know. But I promise you the third thing on models. Now, this is a little bit of, as you may be aware, I've written a lot about mathematical models and the benefits of modern finance in terms of the financial system and so forth. I'm a big fan, okay? But in both my Royal Society keynote and then, doesn't matter which one of these, my Nobel lecture, where most of that lecture is devoted to talking about all the benefits and the interests and so forth. In both of those, I made clear what I think everyone who's in the profession knows. That, any virtue could become a vice when taken to extremes. Mathematical models are mathematically precise, but they are simply abstractions and therefore incomplete descriptions of complex reality. And one must be careful when using them to know their limits. That's the translation. Why am I putting it there? I just wanted, because people have been writing and saying things like, none of us knew any of this. We were all, just putting everything in the models and turning it on and all going fishing. But let's get to what are one of the implications of this incompleteness, which is inherent. There is no model that is fully complete. What are some of the things we need to look at structurally about this? I take something which is topical. Topical in the sense it has to do with credit ratings by a rating agency, topic that's been discussed now and then in the last 18 months. One way to think about credit evaluation is there are 3 factors that enter into the evaluation of a bond. One is the probability of default. What's the chance? If it's 0, it's a risk-free bond. The second is, if default occurs, how much do we expect to recover? Do we expect to recover 10% or 90%? Common sense says that makes a difference. And third, which is a little more subtle, in what states of the world does the default take place? If a default tends to take place when times are bad, the marginal value of a dollar is higher in bad times. It's more painful than if a default takes place in good times. Therefore, holding the other 2 fixed, the one who has defaults in bad times, more likely to be in bad times, is less valuable, it requires a higher return because When that happens, it tends to happen when we're poor, when a dollar is worth more. Now, what is that? That's simply saying that loan, those assets are pro-cyclical. Pro-cyclical means they do well when they go up, when times are good, and they do poorly when they go down. So if something is pro-cyclical, it's going to have the feature that defaults are going to take place more often in bad times than good. By the way, what do we use for that? Beta. Right? Isn't beta a measure of the pro-cyclicality of an asset? Systematic risk? And what do we know? Our models all say that if beta is higher, higher required expected return. That's just a restatement of what I just said quantitatively. You require a higher return on those things that are pro-cyclical. All right? So those are the three. Now, take a particular rating. I put S&P and Fitch up there. I left Moody's out only because they were ambiguous. S&P and Fitch were unambiguous in saying when they assess the credit rating, they only look at the probability of default. That's what they said. That's what they've written. So just let's stipulate that. Okay? So obviously, it's an incomplete model. It's only considering one of the three factors. All right, what are the implications for behavior? Suppose that we have a CEO of a firm who is the most ethical, straightforward person that we know. No exceptions. We run by the book. We always do things right. We're ethically correct. And anyone who's hired is told, if you don't like this, you're going to be fired, so you better not come. And let's say that CEO is successful in getting those kind of people, and they're also very competent. They're good estimators of probabilities. Sounds like a pretty good firm. Now the CEO gives the directive to the staff and says, look, I want you to put together a portfolio of things. I want it to have a AAA rating. That's a constraint. I want it to have a AAA rating. And I don't want you fooling around. I'm not doing anything wrong. I want you to call it as you see it, your best estimates of the probabilities, everything. Okay? So everybody hears that, and that's what they do. And now they put together the portfolio based on that. Well, what is the good behavior that we always tell people? We teach it. I'm sure you teach it here. I teach it at Harvard. Everybody that I know seems to teach it, which is either maximize value, subject to the proper constraints, always doing the right thing ethically and with your estimates. So we're not talking about maximizing value by cheating or doing shady things. Maximize value, doing the right thing. Here's the constraint. Or what's the other one? Minimize cost. We're doing the same thing, okay? The key is there's an optimization involved. What will be the effect of that on a portfolio that's constructed in the most ethical run firm that we can find? Without looking at any data, I can tell you exactly what that portfolio is going to have as its properties. It's going to be loaded up with securities with a very low expected recovery rate, and they're going to be very pro-cyclical. How can I tell you that? Well, I can tell you that is since neither of those factors affect the constraint for the AAA, which is the probability of default, but they do affect the value of the bonds that go into portfolio. Since bonds with, two bonds with the same default rate probability, the one has a 90% expected recovery, one has 10%, which one do you think is cheaper? It's the 10%er. Between the two that are the same on the first two factors, one's pro-cyclical and one's not. Which is going to be cheaper? The pro-cyclical one. So simply by optimization, even though we don't know, if we threw darts, whether we're getting high quality, high recovery or not, through optimization, you get a bias. And the bias is going to push in that direction. Now, by the way, can anyone think of any asset out there that's been discussed that has the feature of low expected recovery rates and high pro-cyclicality? Well, in the United States, one of them is subprime residential housing. Something to think about. I'm going through this with you because this is always going to be there, and we need to address it. And it looks like, after the fact, that these very ethical people who ran the company as best they knew how were purposely circumventing the intent of what was going on. Because look what they did. They loaded up with things that weren't being looked at. And I put that in here not to be defensive, but to point out that you can have behavior-induced that ex post looks like you have a bunch of sleazes or a bunch of people who are always trying to arbitrage or somehow do something with the rules or regulations. And I was pointing out that it's a result of a computation. And that's important to understand. Okay, so that's what I had to say here about models. I'm getting closer. Okay. Now we're on to my last. And no matter how I try to do this, I never have enough time, but that's my fault. Okay. Last topic is government policy. The first one I mentioned at the outset was if we're going to do regulation and legislation, we must be very conscious of what is called unintended and unanticipated consequences of social actions, in this case, the legislation or the regulations we impose. In full disclosure, this was something my late father, who was a really serious academic, wrote about in sociology. So I guess you could label it as also behavioral. But in any case, the idea here, and I'm not going to go through the examples of the time, but let me just mention one. We've talked about imposing regulations on hedge funds as an example. Nothing wrong with that. But you better understand not only the manifest functions of hedge funds, but their latent functions when you pass those legislation. You've got to make sure that the legislation you pass doesn't interfere with that, or if it does, what you're going to do about it. And what I mean here is, as somebody who's been in hedge funds, and you don't have to be one to know one, the first order, if you ask people while running hedge funds, what they're trying to do is make a lot of money for their clients and then for themselves. Okay? That seems to be the manifest function. That's what they go to work thinking about, most of them, every day. But an important function served by hedge funds is that they are intermediaries to the intermediaries. They actually perform the function of dealing with the institutional rigidities, particularly in a global system of which regulations, whether it be tax, accounting, or whatever, as well as other rules, impose constraints that were not intended to be the constraints. You understand, I'm not talking about getting around it, but like a fixed speed limit, sometimes the speed limit's too low and sometimes it's too high. And depending on weather conditions, for example. Same thing with any rule or regulation. When you fix it, sometimes it has impinges in ways that were not intended. Right? We're not part of the legislation, but they nevertheless do. And they're real. So when you're running up against a constraint that you can't do anything about, and there's a high shadow cost to it, if you can alleviate that constraint, you're willing to pay for it. It's a service. What do hedge funds do? Why do I say hedge funds do this? Well, because if it's a bank, it's an insurance company, if I'm regulated the same way it is that the entity has the institutional rigidity, I can't do anything for it. One bank can't do anything for the other bank in this situation because they're all against the same constraint. What you need is something that isn't constrained. Well, what is the definition of a hedge fund? The only thing that's common to hedge funds, they do everything, is that they're lightly regulated, at least they have been. Well, if you were going to design an institution to be on the other side of institutional rigidities, it would likely have to be lightly regulated. Does that mean it's wonderful and has no cost? Of course not. Everything's a trade-off. There's cost and benefits to everything. But that's a functionality. And I would say, by the way, that's just something which I explained to investors when I was involved in a hedge fund 15 years ago. This is not some new thing that popped in my head today. I explained that's how we made money, or we thought we would make money. Not because we were faster, smarter, better models, or the counterparties were dumb. We were providing a service. And if you see the U.S. Treasury swap curve went negative, that's a little bit of evidence of what happens when you disrupt the intermediation when you have institutional rigidities. Not that that's the end of the world, but it's a symptom of much bigger things. So this is not a hypothetical. So if you're going to regulate hedge funds and you're going to make it so they can't do what they did before, fine. But then you better have an answer as to what institution is going to perform that function. If you don't, you're in for trouble. And they're going to be unanticipated trouble because you didn't think about it. That's my message on this. Think about it. There's so many examples of this. I'm sure you have many of your own, where we have to analyze both manifest and latent functions, because the latent functions are often the most important. for institutions. What are they doing? What are they supposed to do? And how is what we legislate going to improve that or not? And if we focus on one thing that we're focused on, but it affects lots of others, there's a problem. One of the reasons that my belief about the regulation changes are that they should be, I'm in favor of regulations, certainly changes to improve things, but they shouldn't be any more than you have to do, because there is no safe harbor. You can over-regulate and under-regulate, and we have to face that. When we do big sweeping things, if we haven't done all the analysis and everything, and there's a really good reason to do big sweeping things, the likelihood that you'll have more unintended consequences goes up. So don't hear this as a defense of status quo. I'm not defending bankers. I'm not trying to protect anyone's turf. I'm just pointing out that there's no safe harbor. If you impose very heavy regulations, you may get safety at one time and you create unsafety and other problems of another. So we have to be smart in using our tools to do that. So that's the first. Now, I had planned lots of other things, but we are now coming up on the last few minutes before the award. So I'm going to, rather than read at the speed of light, I can tell you everything I have to tell you, but I can tell you it so fast that nobody would understand what I was saying. I'm not sure you would understand it before, but you surely wouldn't. So let me just kind of summarize where I was going, and I think it's all in the same spirit. And perhaps those of you who have an interest, I'll either talk to you about it when I see you, or eventually when I write this up, and you can read it, or you can say, I've got better ideas. Now, one of the things I wanted to talk about, is this issue of having been involved in this sort of thing, the difference between liquidation and asset management. The United States' policy has been they're getting all these assets, and they've been talking about it, that what they want to do is, as fast as possible, liquidate them. And I'm saying that may be right, but I can tell you that in firsthand experience that when I was involved with long-term capital, if you don't know what that is, let's look it up on the internet. I bet you'll find it. I was involved in long-term capital. Warren Buffett tried to buy it. We wanted to sell it to him for $4 billion. And unfortunately, for technical reasons that, stuff happens, it didn't get done. And so it ended up, the consortium of banks took it, all right? And they paid $3.6 billion. So they paid $400 million less than Warren Buffett. Now, it was run to orderly run the portfolio for as long as necessary, but with an inside view that would bring things down. As a result of that, the consortium made about $900 million to $1 billion profit. And it was wound down over about a year or so. Mr. Buffett wasn't buying it to liquidate it. He had no reason to. Why would he want to buy it to liquidate? He was going to hold it. Had he gone and held it, at the end of 12 months, he would have had his $4 billion been worth $8 billion. Now, I tell the story, this is not, I'm taking valuable time with you, so there should be a purpose for this other than chatting. The purpose that came to mind is Buffett was an investor. The consortium was a liquidator, a very orderly liquidator, and took time and made money on it. But when I saw $4 billion versus $1 billion, a thought came to mind. The United States, and I don't know, here in Europe, must be parallels, is going to end up in this with how many trillions, I don't know, but every kind of asset under the sun. It won't just be real estate. It's going to be insurance company shares. It's going to be a whole bunch of, a grab bag of assets. And if you announce you're going to be a liquidator, I can promise you that those asset prices that you're going to get aren't going to be really great, because no one's going to come into the market until those assets clear. And that can take years. The RTC in the last crisis took 8 years. My thought, and I only use the term sovereign wealth fund because we all know what they are, we think we do, but maybe the United States ought to create a sovereign wealth fund, put all these assets in there, get it out of the Federal Reserve. We certainly don't want to leave it there. Get it out of the Treasury. We don't want to leave it with debt managers, and we certainly don't want to give it to our Congress. Put it in a sovereign wealth fund, let's say a la Norway, and have professionally managed for the American people to get the most out of it. If it gets liquidated in 12 months, wonderful. If it takes 20 years, okay, just optimize. That's the thought. The paradox of too much power. I came to New York, and I came to New York, make a contract, sign it, and it would be enforceable under New York law. Okay, as long as we can get you. They'll get me for sure, okay? Government signs a contract. Why? Because they can change the rules. So that government always paradoxically can't deny can. That's the essence. So think about that and what it can do. It's a paradox. It's precisely because you can change the rules that you can't commit. And they're saying this is clearly got to go, but it's pretty important, and it's something I do know a little about from understanding. Is when LTCM, which was a very large financial institution, was of Morgan Stanley in terms of balance sheet and everything else. It was a very large hedge fund. When that was done, there were no defaults. It went. Lehman Brothers, another kind of financial firm, was later default. And that was a big problem. And sheds. The difference, people in long term didn't come out with any money either. That I can attest to. The difference is that when you infuse the capital, there are no defaults, you have the whole thing. So the risk you're exposed to is the net of the institution. When you let bankruptcy happen, it's the gross risks. Because financial institutions, unlike auto companies, or real auto companies, and ball bearing manufacturers, have huge assets and huge liabilities, most of which are very close in match, like 29-year bonds long and 30-year bonds short. Okay? So the net risk of the book, of the whole firm, is pretty low. But the gross risk, looking at the variation of either side, is enormous. You see that? If you have two things that are matched to move together versus letting them go. I mean, I'm trying to get you through the intuition fast. If you let bankruptcy occur, even with mark-to-market collateral, because the two sides are not held by different counterparties, each of their reactions will be to treat that side as an uncovered risk. And I could take you through the impact of that. And that event is huge. And to give you an order of magnitude, I mentioned 29 years. This is called the off-the-run, on-the-run trade. It doesn't matter. It's a very common. If you go long, let's say an off-the-run 29-year U.S. bond, and you go short 30-year bond, the aggregate variation of each of those is pretty high. I mean, but the difference of them is like 3 basis points, tiny. So that's where I mentioned it could be as large as 40 times more risk if you let it go to bankruptcy. Well, if you don't get all my lyrics on this, you know, at least I hope you hear the tune. Namely, that there are a lot of things that we as professionals can bring to bear here to help not only address this crisis, to help try to fix things to be better in the future. And these are huge challenges, but they are fantastic opportunities. And there's been talk about, let's get the financial engineers or the financial science people out of the firms. That's not the problem. If anything, what we need to do is educate senior managements, boards of directors of these institutions, and their regulators in finance. They don't know enough. Not that this, they don't know enough. If you don't know enough, there's no way you can deal with these things. You can't put me as the head of the National Institutes of Health, and I don't understand biotech or I don't understand drug discovery. Not as a great researcher or even as a sophisticated engineer, but just as base knowledge. That's what we need. So I thank you all for your attention. I apologize to you all for running over. I think you knew I might. But what I wanted to say to you is a message at the end. There's a lot to be done. There are great opportunities, and schools and universities like here at Bocconi can offer knowledge and offer base. I would suggest you consider programs to help educate senior management. It's very designed for them, not the same thing you teach to your undergraduates, graduates, or someone who's going to make a career of it, but those things. But there's so much you can do to help, and it's really needed. And thank you very much for your attention. Bye.